Now, everything we're talking about today is a fixed interest rate. Okay, we've discussed in the past the difference between fixed and adjustable, and we've decided that fixed makes the most sense. When we talk about a fixed interest rate, what we're really referring to is the principal and interest portion of the loan. So over the next 30 years, if you keep the loan that long, you'll make the same payment each and every month. A portion of it will go to principal and a portion of it will go to interest. As your balance gets smaller because you're paying down the principal, the amount of interest that accrues is smaller, so more of your payment goes to principal. That's why when you get your first mortgage statement, you'll be like, wow, I'm paying almost all interest out of this payment. And the reason why is because that's the largest your loan is ever going to be.
Okay.
Next month, it's a little bit smaller, so you pay a few dollars less in interest. It'll take a while, but at some point it'll even out. And the idea is that you're going to have a fixed level payment. You'll know exactly what that payment is each and every month for as long as you have that loan. It will never change. You can always pay extra. The loans that we're talking about today have no penalties for paying more.
Okay.
You can pay it all off. You guys win the lottery tomorrow and you want to pay it all off, go for it. If you want to pay a little bit extra, some people will round up to the next 100 and pay a little extra, and it will speed the process. If you ever pay, for example, like a double payment, that's great. But that does not mean the next month you can take that month off. You always have to make the minimum payment regardless. So before you apply a large amount of money to your mortgage, make sure you don't have any other plans for that money because you won't get it back. It's great because you're going to pay a lot less interest, and I advise you to do that as often as you can. But that's not money you can just say, you know what, let's not make a payment this month because we're way ahead. You won't get ahead on your mortgage.
Right.
You'll pay it off faster, but you won't get ahead. You always have to make a payment.
Good to know.
Now, your property taxes and your insurance are property specific. So you might be in an area that taxes change because of the bond elections, and that area particularly wants to do some improvements to the schools. So they've voted to increase property taxes on an annual basis for all the homeowners, and that would affect your monthly payment. Same thing with your insurance. You know, you go out and buy a fancier car, your insurance may go up, or the discount may go down, whatever the case may be, and your insurance premium could go up. Vice versa, they could both go down, but more often than not, if they change, they go up. So you will see some fluctuation year over year with your taxes and your insurance, which means your monthly payment could change. Typically, it's not a large amount, but it can happen.